Okay, and we're live. Good evening, everyone, and welcome to Future Proof. Evening. I see a few comments. Hello, Mickey Mouse. Hello, Amaramsha. Hello, Chia Xiao Hun. And hello, Alex. Welcome, everyone, and good evening to you all. Thanks for joining us this evening. All right, so let's get started. So today is Thursday, the 17th of June. I hope everyone is staying safe and everyone is staying well. And I hope everyone is doing well. So our MCO has been extended till the 28th, so another 2 weeks. Hi, KP Chin, welcome. Good evening to you. Yeah, thank you for joining us. Okay, so so I hope everyone is staying safe and we can do this, right? We can do this. Okay, if you're just joining us now, just doing a mic check, please put a thumbs up if you can hear me loud and clear. Thank you. Just waiting for confirmation on the sound check. Okay, if you're joining us for the first time, welcome. And if this is not your first time, well, welcome back, right? Look, you can be joining us from any of the three. You can be here via Facebook or from YouTube or Twitch. We had some previous issues with YouTube in the not last week, but a couple of weeks before that. So hopefully we don't have any more trouble. I had engaged with the YouTube team to sort it out, and so it was sorted. So hopefully it stays that way. And if you're just joining us, welcome. Now, please don't forget to share, like the video. Just click on the like button, and feel free to subscribe. If you're coming in from YouTube, then click on the bell icon and select all. That way, every time we come on, you'll get a little notification on your mobile phone, and then that way you know that we're going live, and then you can come in and join us. Feel free to, obviously, if you're on Facebook, follow us. If you're on Twitch, follow us. Feel free to tag your friends. Get them. Okay, thank you for the confirmation, Alex and KP Chin. Feel free to tag your friends if you feel that they might be interested in tonight's topic or the current topic or any topic that we talk about in Future Proof, where we try to figure out what's happening, around the world from a macro perspective and from a technology perspective, and we try to break it down and simplify it and sort of help everyone and update everyone on this show. So thank you for joining us, everyone. Okay, so tag your friends. Throw in any questions during the presentation. Just throw it in, and I will get to it either on the spot or we'll wait for the end, and then we'll answer questions. Last week we had pretty good engagement when Dino was on, and we were looking at social sentiment analysis. We were looking at the social feed, and we were also looking at on-chain data analysis, and so there were a lot of questions, and that's good, right? So if you have any questions, just throw it in. Thank you, Ailey, and so we will go through that. So tonight we're talking about banks versus Bitcoin. It's not as bad as you think. But it's information packed. In fact, the deck is quite a lot of words, but we'll go through it together. Let's see, any announcement? No special announcement. Okay, so let's just hop right into it. Okay, let's hop right into it, and let me share my screen now. Okay, I think this is it. Let me know if you can see my screen. Okay. Okay, let me present that. All right, so tonight's topic, banks versus Bitcoin. Okay. Now, as usual, the disclaimer, anything that I talk about tonight is not financial advice. right? It is not investment advice. Therefore, don't make any financial or investment decisions into buying anything without first consulting with your financial advisor, right? I am not a financial advisor, and therefore this is not financial advice. This is just some research that we've done, and we're sharing this in hope that it'll save you some time, and there'll be some takeaway from this. So, yeah, not financial advice, guys. Okay, so as usual, I am from Equities Tracker, and so we talk stocks, we talk about technical investing, we talk about crypto. So do check out our website equitiestracker.com and sign up for a 2-week trial. And you could see what our research platform is capable of, and it'll help you in your investing journey. Okay, so let's kick this off. Now let's take a peek at the big boys, right? When we say big boys, we mean the banks, right? The really big ones. Now, if you look at the top ranking banks, right, and if we take out the big 4 Chinese banks, right? Let's focus on we've got JPMorgan Chase. You have Bank of America, we have Wells Fargo, we have Morgan Stanley, Citigroup, and as well as Goldman Sachs, right? Now, if you add the 6 of these banks together, right, they make up 77% of all the total market cap of the big boys, excluding the big 4 Chinese banks, right? So they're huge, right? And they are quite substantial in terms of their size. So now, why are we focusing on these 6? Because they have actually issued research, and they've actually talked about how they view Bitcoin and what their views are, and that's what we're going to do tonight, right? So we did the hard work for you guys. We went through their research, and then we've summarized it, and then we're sharing this tonight so that you don't have to read a few hundred pages of the research material. So to start off with, so this was an article from Financial Times, and it talks about how the crypto movement is going mainstream, right? More and more people are adopting it, more and more institutions are adopting it, and a lot of the veterans within the incumbent or within the financial industry are actually moving across from Wall Street to crypto, right? To name a few, you've got Goldman Sachs lobbyist Fayyad Shahzad, right? He's going to Coinbase. Coinbase is one of the largest cryptocurrency exchanges in the world, as well as in America. They're listed on NASDAQ, and their ticker is Coin, right? And so you've got Goldman Sachs guys going over to Coinbase. Citadel Securities veteran Brett Harrison, he's joining a crypto exchange called FTX. FTX is founded by Sam Bankman-Fried. Sam Bankman-Fried is 20. He's a bit of a genius, right? He's 28 or 29. And during the 2017 crypto bull run, he actually made about $10 billion. Yes, you heard me right, $10 billion in arbitrage trades. So for those of you who do remember, back in 2017, there was what's known as a kimchi premium. Now, Bitcoin, as you know, Bitcoin is sold all over the world, right? And but the pricing between the Bitcoin that was sold in America and the Bitcoin that was sold in Korea, there was quite a premium to the price of Bitcoin. And I think at its height, it was 20%. There was a 20% premium. Now, whilst the whole world focused on Korea, what they kind of didn't look at Japan. And so Sam Bankman-Fried, what he did was he started with a $200 trade to figure out how it all went. So basically, he bought Bitcoin in America and he sold it in Japan for about a 10% arbitrage. So he made a 10% profit, and then he would recycle that money, send it back to America, buy Bitcoin again, and then send it onto a Japanese exchange, sell that for yen, and wire the money back. And he kept doing this for the whole 2017, and essentially came out a billionaire, right? Obviously, he had to explain to the banks that they were not money laundering, they were doing crypto exchanges, it was an arbitrage trade, but he needed an army of lawyers to actually to explain to the banks what they were doing, right? Because this was unheard of, and they weren't familiar with what was happening. So he obviously founded FTX, and that is the FTX crypto exchange. And imagine, right? This guy's only 29. Yeah, billionaire. Okay, then you got John Delby. He's the ex CFO of Bridgewater. Those of you who don't know who Bridgewater is, you may have heard of a guy named Ray Dalio. So Ray Dalio is the founder of Bridgewater. It's an asset management firm, one of the premium ones. And Ray Dalio is very famous for a good reason, right? He's got a very sharp mind. He's a very smart guy, and he manages billions and billions of dollars, and he's done very well. And so the CFO of Bridgewater is jumping ship, right, and joining a crypto financial services group called NYDIG, right, New York Digital Investment Group. So you see quite a few people who have sort of woken up from the existing sort of industry, and they see, right, what is happening within their industry. It might look like a bit of a bit of a wild west, but then they're going into it, right? And so they're packing the bags and they're crossing the street. Now, again, you may have heard me talking a lot about MicroStrategy. And for those of you who are new and you don't know who MicroStrategy is, MicroStrategy is a publicly listed company on NASDAQ. Their ticker is MSTR. They are an analytics company, and it was founded by this guy called Michael Saylor. Now, very recently, now they've done this a couple of times, but very recently they have just issued some senior secured notes that's due in 2028, so about 7 years, where basically the offering was $500 million, and what's interesting is $1.6 billion came back, right? So everyone had to sort of cut what they could get of the notes. So these notes are effectively bonds, right? And I've even heard on CNBC, they call them junk bonds, where they offer 6.125% of annual interest on these senior secured notes. Now, for those of you who are unfamiliar, a senior secured note basically gives you priority in case the company winds up, and you have priority. If a company winds up and goes into administration, you have priority in getting your money back first before any other bonds. So it's a pretty good position. So the notes were sold. I'm just going to read this out. The notes were sold in a private offering to qualified institutional buyers, right, in accordance with their Securities Act, and in full compliance, obviously. Now, this is interesting because so here is Michael Saylor offering an opportunity to buy, right, into some debt, into some junk bonds, right, and he only offered 500 million. Now, if you look clearly at what Michael Saylor is doing, it's very interesting because he seems to be dollar cost averaging, right? I mean, he could have taken the whole 1.6 billion that came back. Well, he couldn't, but you could see how strong demand was, right? So he got 1.6 billion dollars back, but he only needed 500 mil. So, and these are qualified institutional buyers, right? So these are big money people, and it's 6.125% per annum for 7 years. So what's interesting is so Michael Saylor posted this tweet, and he goes, "Do you expect the price of Bitcoin to appreciate more than 6.125% annually over the next 7 years?" So about 110 people, no, 113,000 votes came in, and about 90% believe that it will. So if you think about it, right? So Michael Saylor is making a pretty safe bet. So that's interesting. So as adoption trends accelerate, banks need to respond. So okay, we're gonna start looking at. So each of these 6 banks that we talked about, they've all published reports. They've all published research reports. They've all given different angles and different views and different stances of where they see crypto, where they see Bitcoin, and I'll go through them. This is super compressed and super summarized, but it's still quite wordy, right? But at least you get the best parts, and that's what you're here for tonight. And hey, don't forget, share these with your friends, right? If you think they can benefit from this. Okay, so Goldman Sachs did it in a Q&A style. Okay, so Goldman Sachs has had fits and starts in the crypto space. Why now for a new launch into the space? So their answer is, well, client demand, pure and simple, right? Apparently, when they first explored creating, they first explored creating their own digital custody offering and launched a trading desk in 2017, 2018. The price action was almost exclusively retail-led, right? So what's different today is the extent of institutional interest, coupled with very strong demand across the wealth management franchise. So what they're saying is, back then, look, we launched our trading desk, our crypto trading desk, but now it's different. But then you hear that every time it's different. Now there's a lot of strong institutional interest. So people are wanting to buy or wanting to get into Bitcoin and crypto, and a very strong demand across wealth management franchise. Okay, so this one is a view from the Bank of America. So it says, although the original idea behind Bitcoin was validation, would be distributed among thousands of idealistic computer aficionados, mining has become a commercial enterprise. So basically what the Bank of America's stance is, they're saying, hey, look, the original idea is great and fantastic, it's decentralized and all that. But if you look at reality, you have, 4 of the largest mining pools who control half the hash power, right? According to Bank of America's view. And they say, if DeFi began to replace mainstream finance, would you be happy with 4 unregulated entities having such a material influence on the system? Now, I think perhaps the researchers at Bank of America may not understand this as well, in that, in mining, there can be mining pools, but then with the mining pools, you can have miners, like, you can be an individual who has bought one mining rig. You can take your mining rig and run it at home, and you decide which mining pool you want to join. You can join one of the 4 big ones that are probably in China. I'm not, but I mean, there are quite a few in China, but you could plug into one of them, but you can as easily plug out and plug into a different pool. So, there is that, and it's with ease, right? It's not that difficult for you to do. So anyway, so that's their view. So it's a little bit like, thanks, but no thanks. But they are, they are highlighting, in their view, the risks, right? So it says, mainstream finance gets tech wrong too. However, if a tech glitch caused my bank to send, £1,000 or $1,000 to a random third party, they would not reply to my complaint with "that's on you." You should have realized that that our software will do that. So what they're saying is, hey, look, you know what? As a bank, there's legal recourse, right? If we make a mistake, we can rectify that mistake. But if you leave it to just software, open source software that nobody owns, nobody runs, and it belongs to nobody, then if there is a glitch in the software, hey, you have no recourse to get your money back. So again, that's a valid point, right? We're in very early days. DeFi applications are up and coming. There are a lot of it. There's a lot of energy. There's a lot of money, pouring into the space. There's a lot of new and upcoming and exciting apps happening. But software is software, and sometimes there will be bugs, and there will be things that the developers had not foreseen or had not thought possible, and and things can happen, mistakes can happen, and so you run the risk of losing some of that money. And so these are all valid points, right? So they say, look, the point simply is that if you decentralize finance, you do away with a clear legal entity to complain about, regulate, and sue. This is the point of it. But you also give up the ability to seek redress against such an entity, right? So that's effectively what they're saying. Now, it's a valid point, and it is valid in a sense that if something does happen, you can sue the bank, or you can complain to the bank, or you can complain to the regulator, and then and you get legal recourse, right? But what I suppose my view is that that is true. But on the other hand, it is also great to have options, right? You want to have different options and different types of offerings available at your disposal. So, yeah. Okay, so this one is a hotly debated one. So again, we're still on Bank of America. So they say that Bitcoin energy use is an ESG issue. So what they're saying is, hey, you know what? Bitcoin uses too much energy, right? And they say, every time Bitcoin's price rises, right, your carbon footprint is going to rise as well, right? So the cost is going to be even more. And they say, so, any excess demand will push price higher. And Bitcoin prices encourage more mining activity because the prices are going higher, which would push CO2 emissions to even higher levels. So I think so this is extremely hotly debated on social media, and I tend to my views are probably biased, but my views are also quite informed in the sense that I understand how this industry works. So my take is this: a Bitcoin miner is in it for the profit. So we go back to Adam Smith, right? We talk about the invisible hand. We talk about letting the free market do its thing, and by allowing the individual entity to be selfish, it is good. It's for the greater good. And so, if I treat this as a business venture, I purchase a mining rig. I want to find the place that has the cheapest cost of energy, so that I can mine Bitcoin, and I can earn Bitcoin, and sell as little Bitcoin as I can to pay for maintenance of energy sources. And oftentimes you will find that these miners are constantly moving, right? They will always find the most cost-effective and oftentimes renewable energy sources where they can set up their mining, right? Where they can set up their mining. And so I'll talk about it in the next couple of slides. Now, so this one is Goldman Sachs, right? So we move back from Bank of America to Goldman Sachs. So this is what Goldman Sachs has to say. It says, do you hear institutional investors expressing concerns over the high concentration of crypto holdings or the environmental aspects of mining. And this is what their views are. This is, well, there is certainly concentration within the crypto ecosystem among a relatively small number of entities, but that's not unique to crypto, right? So you gotta understand that that's not unique to crypto. It's, you know, other commodities, shares and stocks, and amongst other things, right? And we do sometimes hear concerns about the energy consumption of Bitcoin miners, but there's quite a lot of misinformation out there around this. Now, this is coming from Goldman Sachs. While mining is very energy intensive, it is extremely competitive. And one way that miners can beat out others for mining rewards is to utilize the lowest cost energy. So miners have moved to lower cost renewable energy sources as much as possible, including solar, wind, hydro, etc. Now, this is the view of Goldman. Okay, so they say this is so this is where they, if you look at the chart, it says that look, Bitcoin's price behavior resembles other macro assets, right? Yeah, I'm just gonna check the yeah. So effectively, so this is what Goldman says. So I'm coming back to this because this is a very interesting topic to me, right? So because I know that ESG's, you know, the awareness of ESG is on the rise, the need for renewable energy resources, and also the need to have clean energy, renewable energy, and not deplete the earth, right? And not pollute our environment. And look, I am an advocate of saving our planet as well. But at the same time, right, I think we need to understand that recently, I talked about this last week, and some of you may have tuned in last week, but if you haven't, I'll talk about it again. In that recently, if you haven't heard, El Salvador has just approved Bitcoin as legal tender, which means every economic entity within the country, right, by law needs to accept either US dollars or Bitcoin for sale of your services or products, right? And here's the interesting thing, right? They announced it on the last day in Miami in the Bitcoin conference, and then the next day they actually took a vote on it, right? They took a vote on it, and obviously it won by a landslide. And then, I think the El Presidente, President Nayib Bukele, I think he has a very good PR team, because over the next few days, his tweets, he showed. Now, those of you who aren't aware, in El Salvador, there are volcanoes, and they actually, so they have geothermal energy. So this is 100% clean energy. It's from the earth. It's from the volcanoes, right? And so what they do is so President Nayib, what he did was he tweeted about, he showed a video, a drone shot of it going around an area where there was just steam coming out from the ground, right? So this is the geothermal energy. And he says, oh, look, we will be building like a Bitcoin mining facilities around this area, where I think it was around 95 megawatt of energy. So it's interesting because if you think about it, recently China has put a ban on a lot of these illegal Bitcoin mining. So, on the ground news has told me that, a lot of these miners are moving away from China, especially those who are illegally mining. Now, those who are doing it above board, I don't think they're being touched, like using renewable energy and all that. So those who are doing, so they will be moving to countries like El Salvador, where they can set up shop and they can use renewable energy sources, and it's probably cheaper. And so I think there's a lot of misinformation out there, rightly so, as Goldman Sachs says. And so, if you are an environmentalist, and you are against Bitcoin because of the energy usage and and against Bitcoin for whatever it is you think it's doing, I would really recommend that you dive deeper into looking at the numbers and looking at what's actually happening, because I think Bitcoin mining actually incentivizes the use of renewable energy. Okay, so I'm going to move on. I'm not going to stay too long on one subject. Okay, so then Bitcoin's price behavior resembles other macro assets. So this one is from Goldman Sachs as well. It says, okay, as its March 17th meeting, the Federal Reserve said most policymakers did not expect to raise interest rates until 2023, later than financial markets had expected. Macro assets reacted in the conventional way to a dovish policy shock. Shorter maturity treasury yields decline. The yield curve steepened. Okay, so basically, so Bitcoin rose just like gold, but with 4 times the volatility. So basically, what they're saying is that, look, it's pretty much like every other macro asset out there. Like if you see gold rise, you will see Bitcoin rise, but Bitcoin has 4 times the volatility. Okay. There's a good comment from Nick. Hey, Nick. Hey, Michael. So Nick says, optimal resource allocation. Yep. That's very succinctly put. Okay. So still on Goldman. So Goldman believes that Bitcoin is like gold, right? But it's going through a phase. So, gold is a commodity, right? Serves a money function and behaves like a currency. Bitcoin is exactly the same, though it is in a digital format and not physical. The main difference is that, Bitcoin is going through a one-time social adoption phase, which may fail or it may succeed. Now, when social adoption is rising, Bitcoin should offer superior returns compared to gold, and vice versa. So that's essentially what Goldman Sachs is saying. Oops. Yeah. Okay. Now, so they also believe that Bitcoin is gaining widespread social adoption. Bitcoin is a medium which is beginning to serve the functions of money primarily as a store of value, right? Or in short, they just call it SOV, store of value. So virtually anything can serve this purpose as long as it gains widespread social adoption. Widespread social adoption. Now, if you think about it, back in the day, right, before paper money, we obviously had gold nuggets, right? And in Malaysia, when we had the bunga emas, even before that, I mean, people used to use stones or shells or feathers, right? All sorts of things to represent money. As long as within that community, there was widespread social adoption. So if there was widespread social adoption for Bitcoin as a store of value or as a medium of which to represent transfer of value, then it'll succeed, right? Obviously, if it doesn't, then it'll fail. And Bitcoin has made meaningful progress down that path, right? So that's what Goldman Sachs is saying. So they're saying, look, the critical ingredient, right, for Bitcoin to succeed is that widespread social adoption, right? And they believe that that's, crossed many notable thresholds. Tesla, right, the 6th largest company in the S&P 500, they're carrying Bitcoin on their balance sheet. Storied macro hedge fund, Brevan Howard, has begun investing in cryptocurrencies, and Coinbase, right, which is an exchange, a crypto exchange, is now listed on NASDAQ. right? And we can name a few more, right? Obviously, a lot of the hedge funds have adopted Bitcoin, and there are quite a few listed entities that have added Bitcoin to their balance sheet, right? Including the likes of Michael Saylor's MicroStrategy, right? So now Goldman Sachs believes that Bitcoin's network, right, is what creates its value, right, making it pro-cyclical. So what they're saying is, the more people that jump onto the Bitcoin network, the more used it is, and therefore the more popular it becomes, the more value it creates. It's known as the network effect, right? If you think about it, if one person in the whole world had a mobile phone, it's not much use. You can't do much with it. But if two people have a mobile phone, well, then they can have a mobile phone each. They can call each other. If three people have it, well, then the network value, you can start seeing the network effect, because A can call B and can call C, B can call A and can call C, and C can call B and A. So then you add another one, and that matrix starts to form, and that is what creates the network value. So as more and more people, right, adopt and come on board, join the Bitcoin bandwagon, then you can see that network value increase exponentially, right? So payment networks are pro-cyclical, and so they believe that greater use of it will drive value, right? And because the value of the network, and hence the coin, is derived from the volume of transactions, hoarding coins as stores of value reduce the coins available for transactions, which reduces the value of the network. Look, simply put, basically it will create, it'll have a network effect as more adoption happens and more people come on. And what they're saying is, as more people come on and more people use it, it creates even more value, right? But if nobody uses it, the value goes down, right? So that's kind of what they're saying. So transactions drive the value of the network. Now, if you've been following us every second Thursday of the month, where Dino comes on from Sentiment, and we look at on-chain metrics, one of the main metrics that we look at is daily active addresses, right? So daily active addresses basically is a metric that gives us a measure, or gives us a view of how busy for example, the Bitcoin blockchain is, or the Bitcoin network. It tells us how busy, how many wallets are interacting with each other. So obviously, if you see a clear trend of a rise in daily active addresses, then what you see is a rise in network value, and what you see is more and more people using it. It's just like in the early days. For those of you who are old enough, myself included, where you hopped onto the internet in the early 90s or mid 90s, right? There weren't that many people in Malaysia who had internet access. In fact, it was difficult to ask someone, hey, do you have an email address? And most people back then didn't. They're like, nope, don't have. What's that? What's an email address? So back then, no one had email addresses. So whereas now, it is so uncommon to not have one, right? And so the network value occurs as more and more people pile in, and that is what that metric is for. That daily active addresses basically shows how busy that the Bitcoin or any other blockchain, how busy it is, and how many are actively interacting with each other, right? So that's one of so basically what they're saying is, look, as more transactions happen, the value goes up. Okay, so what they're saying is, look, miners, exchanges, and developers, right? They're all paid in Bitcoin, making them fully invested in Bitcoin's success. Similarly, users like merchants, investors, and speculators they're also fully vested. So this gives hodlers incentive to accommodate purchase of their own products in Bitcoin, which in turn creates more demand for Bitcoin they already own. So it's according to Goldman Sachs, so this is why it is rising, and this is why it's in Goldman Sachs perspective, this is what's happening, right? So the big picture is this: Goldman Sachs, they now recognize Bitcoin is an asset. Now, this is an interesting part, because if you look back, right, barely a year ago, they actually said that crypto is not an asset class. Today they're saying yes, it is an asset class, but about a year ago they're saying, oh no, crypto is not an asset class, right? And this is actually from their deck, right? It was taken in May 27th, 2020, right? It says cryptocurrencies, including Bitcoin, are not an asset class. Why? Because they do not generate cash flows like bonds. They do not generate any earnings through exposure to global economic growth. They do not provide consistent, blah, blah, blah. And these were the reasons on why it wasn't an asset class. But today, they're saying that it is, right? So that's pretty interesting. Obviously, it's because they had, different differing departmental views as well on Bitcoin, crypto to reflect the case. But the case is this, right? Today, yes, it is an asset class. Last year, no, it wasn't an asset class. So this is interesting how they've come around, right? As Alex says, they've done a U-turn, right? So this is interesting. Maybe they have had an epiphany. Maybe they have figured something out, and I think it was quite clearly defined in their research in how they view this. So now let's turn over and look at Morgan Stanley. All right. So Morgan Stanley compares Bitcoin to gold. Right. So they say, look, Bitcoin is on a path towards financial market maturation, thanks to institutional endorsement. So they're saying, hey, now that all the other institutions are in, look, and they've endorsed Bitcoin, it is now maturing. Now, gold took nearly 2 decades to transition from a new asset class, a new asset, into a recognized part of institutional portfolios. So this is interesting, right? So the price of gold had been fixed at $35 an ounce in 1933 until 1971. So between 1933 and 1971, gold was just fixed at $35. So gold as an investment was illegal in the US as well until 1974. So from the mid 1970s to the early 1980s, gold became widely available through brokerages and retail-oriented products. Gold hit $850 in 1980. That was $35, then it hit $850. Okay? Just to give you a bit of historical context, on a new asset class, right, or the recognition of a new asset class. Actually, so I'm just gonna. Yep. Now, Morgan Stanley says, 4 forces are creating this inflection point for crypto, right? One is broader adoption of digital wallets. That's true. Well, not these days because we're under lockdown, but every time you go and you pay for food, right? And there's so many options to pay. You've got Grab Pay, you've got Boost Pay, you have all these other QR codes that are out there. And you whip out your phone, you're like, you whip out your wallet, you're like, okay, I can pull out a credit card, or I can whip out my phone, and which app do I open to pay, right, for the food I've just had? So there is, and because now everyone's got a mobile phone and they have internet access, it's so easy to just pay, right? So the adoption of digital wallets, right, payment systems, right, is increasing, okay? The surge of policymaker-driven global liquidity, right? That rendered most traditional asset classes fully valued in a historical context. Now, what this means is, quantitative easing, right? You've heard them say the money printers keep printing, right? The ECB, the European Central Bank, has committed to printing as much euros or creating as much euros as they need to handle the current pandemic. The Federal Reserve have also, been increasing the money supply. Under Biden's proposal, I think it's something like $6 trillion that will, be created. So the traditional asset classes are, there are existing valuation models where you can value them, and you can, so a lot of it has flowed into those traditional asset classes, right? And so now it's probably even overflowing into a new asset class like crypto, right? So the third point is dwindling lists of diversifying and uncorrelated assets. So if you're a portfolio manager or you're a fund manager, what you really want to do is you want to spread your risk, right? You are charged, right, with the handling of people's money, and you want to take as little risk as you can, and you want to make sure that those who have charged you with looking after their money don't lose money, right? You want to do it as best you can. And so what you want are non-correlated assets within your portfolio, right? So you could allocate, like recently Paul Tudor Jones came out. He says, look, he's going to allocate 5%. He came out last year and he allocated 2% of Bitcoin, and now it's increased to 5%, right? So he wants to allocate 5% of Bitcoin. So to get these non-correlated assets, there aren't that many out there. So there you go. Okay, so rising risks of debasement of traditional fiat and reserve currencies. Now, as I mentioned, not just the Federal Reserve or the European the central bank, but a lot of central banks around the world, because of how COVID has hit us and hit our economies, and I'm sure we're all feeling it right now. Governments have had no choice but so that economies and societies don't self-implode. They have to keep debasing their currency. They have to keep increasing the money supply to effectively give out to people so that they don't die, right? And these are more for even the Bank of England has done it, right? The Reserve Bank of Australia has done it. Surprisingly, Malaysia has done pretty well. We haven't actually increased too much of our currency, but I don't know. We might be getting to a point where we may have no choice, right? A lot of countries have had no choice but to do that, right? To increase the quantity or the amount of money in the system in order to sort of spread it out and get it flowing in the economy, right? To have that velocity of money. Okay, so these are the four factors that Morgan Stanley sees. Okay, now let's move on to the Citigroup. So central bank actions may be driving Bitcoin moves, right? So I'll just take it from the quote where they said that there's a good correlation between Bitcoin's price movements and China's 12-month average total social financing, TSF, or credit creation, and change in US M1 money supply. So basically, while central bankers are generally they're crypto skeptics, their actions may have supported investor interest in Bitcoin and peers, right? The growth in money supply has fed the buy the Bitcoin as a fiat currency debasement hedge narrative, right? So the more money they print, the more they're driving, those who are charged with managing a lot of money to basically hedge their risk against the debasement of the currency. So that's Citigroup. Yeah, funny. I've got a couple of comments which I'll flash. So this is from Alexander. He says, interesting that crypto is banned in China. The US took a similar stance with gold in the past. What will happen when China lifts the ban? Look, this is probably not the first time that China has banned Bitcoin. They've banned it so many times in the past, right? And when I say ban, I mean ban, right? So let's see. But obviously, China is also working on their central bank digital currency, which they call the DCEP, Digital Currency Electronic Payment System. So they're definitely working on that. Nicholas, yes, helicopter money. And like it's so going back one right, one slide. Like if you put yourself in the position that the leaders are at, um, you almost have no choice, right? In a pandemic like this, you almost have to keep printing money and literally giving it out, right? In America, they call it stimmy money, right? Stimulus money, and they're just literally giving out money to stop people from dying of hunger and not being able and stop them from being kicked out on the streets because they need that stimulus money. But so it there's almost no choice for these people in that position but to print money and to give it out, right? And but of course, if you're on the other hand and you're lucky enough to have accumulated a lot of money, well, if you're keeping your money in cash and then you add a bunch more money into the total money supply, then as a percentage of the total money supply, your percentage would have gone down. So naturally, you would move some of your money into assets, which will inflate because everything inflates when you increase the money supply in the system. So yeah, look, that there is no right answer, but it depends on like which side of the divide you're on, right? Okay, so Citigroup, Bitcoin is firmly an alternative investment class, right? At the moment, classic Bitcoin is firmly in the realm of alternative investment. If people believe the price will go up, it is unlikely they will use the instrument as a method of payment. So that's their view. Now, Wells Fargo. So Wells Fargo says that crypto is driven by long-term trends, not short-term factors. So rather than pandemic or policy factors, long-term supply and demand are main factors in building stability for crypto. So they're saying that decentralized systems such as DeFi apps boost accessibility and cut processing costs, while smart contracts can execute contracts automatically. Right? They also say that disruptive potential of decentralized systems could be large across the economy. They also say that crypto is driven by long-term trends like automation, systems automation and AI, where they said cryptocurrencies complement the rise of AI by connecting payment systems to the broader automation trend. Now, I'm sure you've heard of the IoT, right? Internet of Things, where your fridge knows that you are running low on milk, and therefore the fridge, which is already connected to the internet, will dial out or make an order for milk so that it is delivered to your doorstep by the time you run out of milk, right? So automation, AI, Internet of Things, where everything's connected. And so I suppose once you attach a payment system to the Internet of Things, then whilst it makes that order, it can also pay, and then the milk arrives, right? So that's basically what they're saying. So the broader long-term trend is the trend of automation, AI, and you tag on, right? It becomes like a subset. You now have digital payment systems or digital money, which pushes it forward. Okay. So it says that if you look at the chart on the left here, right, that pink bit is basically Bitcoin. So this is a chart of up to 100%, right? And then the rest are, you've got Ethereum, you've got XRP, and then you have others. So over the years, right, you can see that it was effectively Bitcoin dominated. Now, if you look at it now, it is still Bitcoin dominated, but the percentage of Bitcoin's dominance has dropped, which means it has given rise to the other currencies, right? So Ethereum has come up, right? And you got the others, XRP and Litecoin, and all the others have sort of eaten into, you could say, Bitcoin's market share, right? But Bitcoin is still in the lead. But then if you sort of zoom out a bit more and you look at this chart on the right, this is the market cap of all cryptos. So if you look at this, effectively all cryptos have actually increased, right? So whilst Bitcoin's dominance has come down, but the entire market has grown. So your pie just got a whole lot bigger, right? Your pie is a lot bigger now. Now, here's what's interesting, right? If you were to not look at this part, you see, 2017, December or January 2018 was the peak, right? And then the market crashed down to about here. It crashed about 85%, right? The price of Bitcoin went down from close to 20,000 down to about $3,000. But then now, when you include the current chart, you're like, oh, that doesn't look so bad anymore. Now, what you can't see in this chart, because this goes to 2014, in 2013, there was also another major sort of spike, right? A major bull run. And it is just a blip right now, right? You can't even see it. So, no, Bitcoin's only been around for 12 years, but the trajectory is quite, I mean, it's kind of pretty obvious. Like it's yeah. So, moving on. Okay, so we're still on Wells Fargo, right? About rising diversification in crypto. That's a positive, right? So so I quote, investments in a greater variety of cryptocurrencies should imply a decreasing percentage of investors who buy or sell on any given news, which in turn should reduce price volatility. So that's good. It already has. The annualized volatility in a cryptocurrency index was 160% between July 2020 and August 2015, but halved to 80% between August 2017 and March 2021. So effectively, as this market matures, as this asset class matures, you will see less and less volatility. And with less and less volatility, that just means that it's growing. So as the market grows bigger, you'll see more stability, right? In the meantime, okay, so I'm getting close to it. So JPMorgan, there's still a prominent crypto bear. So in JPMorgan's 2020 annual report, they make one mention of crypto, and they made mention of crypto in a negative light. So I'll quote it. It says there are serious emerging issues that need to be dealt with, and rather quickly. The growth of shadow banking, the legal and regulatory status of cryptocurrencies, the proper and improper use of financial data. Look, of course, JPMorgan would say that. I mean, they are, one of the largest banks in the world. Are they? They're potentially threatened, maybe, right? But this is the mention that they've made. But JPMorgan, they do seem keen to develop their own digital asset, right? So in mid-May, post for a senior digital assets platform engineering lead calls for candidates who understand proof of stake consensus mechanisms and experience with Ethereum and Bitcoin, the latter being a huge plus. So they could potentially be trying to develop their own coin, right? So not one that is owned by nobody and controlled by nobody, or owned by everybody and controlled by everybody, but one that they control, right? So that's probably what it is. Okay, so now let's take stock. Like we've looked at all these banks now. Let's do a quick summary, right? So the majority of banks we looked at, they're actively making the case for crypto as an asset class. So yes, tick, right? Um, the theme between all of them is Bitcoin adoption is on the rise, right? So Bitcoin adoption, it's coming into mainstream, right? The Bitcoin adoption is on the rise. Their views diverge on exactly why, right? So, but they all agree that look, Bitcoin adoption is definitely on the rise. Active debate and discussion over crypto will likely stir up more actively and more interest in this space. Okay, now I'll just summarize by bank. So Bank of America, no good reason to own Bitcoin unless you see prices go up. Right? This is just a very quick one-liner summary. Goldman Sachs, Bitcoin is a commodity fueled by network effects, a macro asset fueled by social adoption. Morgan Stanley, institutional endorsement is helping crypto mature as an asset. Citigroup, an alternative investment asset driven by fiat debasement narrative. Wells Fargo, improving depth and breadth, more crypto assets and interesting use cases like DeFi point towards gradually maturing marketplace, focus on long-term potential. JPMorgan may be developing a Bitcoin rival, right? One that they control, at least. Okay. Look, it's 9:02, and I think I'm in my last couple of slides, and this is probably so that's where we're up to, right? From all those reports. Now, so why are banks shifting their tone towards crypto? I mean, if you remember, banks have always been pretty anti-crypto. In fact, you can't even make crypto purchases. A lot of banks in the earlier days, they won't serve crypto exchanges, right? It was probably too much hassle for them. Okay, so last year we definitely saw many clients exploring rather than executing. This is Goldman Sachs. From what we see and anecdotally here, that seems to be changing. A survey from our digital asset team conducted in early March found that of the 280 clients that responded, 40% have exposure in some form of cryptocurrency, in some form to cryptocurrencies, with 61% of that group expecting their holdings to increase over the next 12 months. And I suspect that would be more now. Now, so effectively what Goldman Sachs is saying, as I read it, is, hey, look, we've got all these bunch of rich people who are our clients. We've just done a quick sample, a quick survey. 40% of our sample already have exposure, but they didn't go through us, which means we didn't earn their fees, which means we're losing out on sales. So if they're going to do it anyway, and they said they're going to do more of it, let's capture some of those sales, right? That's probably as plainly as I can break it down. That's what it sounds like to me, right? It's like, hey, look, if there's good business to be made, I want in. That's what it sounds like. So what greater adoption of crypto could mean, right? So should more nation states begin using crypto as legal tender, banks will have no choice but to run with it, as they need to collect deposits to survive. Now, what this means is, look, I think for those of you who aren't aware, the kind of banking system, how the banking system works is that there's a multiplier effect, right? So it's the fractional reserve banking. So if I put $1 in a bank and I deposit $1, a bank can lend out, for example, $11, right? And that's how it works. And obviously, the dollar that I put into the bank, I will earn a small interest on, and the $11 that they lend out, they will earn more interest on that, and that kind of keeps the whole system going. So if less people are putting their money into the banks, then they can lend out less, which would lead them to earn less, right? If all this money is sort of leaking towards other investments like crypto. So financiers have deep ties with governments around the world. Thanks to the revolving door, many ex-bankers now run or advise governments. Many banks are also a major buyer of government bonds, so they enjoy exclusive insights into these developments. Now, right here is just a headline on CNBC, right, where I talked about El Salvador looks to become the world's first country to adopt Bitcoin as legal tender. Look, they've already passed that bill, right? It is legal tender, right? And so look, guys, we're watching history in the making. I am pretty excited that I've got front row seats. What a time to be alive. Like, this is an inflection point in financial history. I'm just so excited. And plus, we're all plugged in to this global network called the internet. It is so exciting to have front row seats. I don't know if this is the last slide. Oh, okay, wait, got a couple more slides to go. Okay, but look, it's happening. Leong Sunto has a question. I'll just flash it up. Any view from Malaysia local banking institutions on crypto? Look, I think traditionally Malaysia has been pretty. What's the word? We've been pretty conservative. So look, I don't have any banking ties per se, and but I judging from history, I think Malaysia is quite conservative in that nature. That look, they'd rather wait and see to see where this thing goes. And obviously, all the central banks around the world, they talk to each other, and they have to come to an agreement to something. Of course, after El Salvador passed that bill, passed that law, they actually went to the IMF to say, hey, can you help us with this Bitcoin as legal tender thing? And the IMF came back and said no. Right. So look, I know, so they all talk, all the central banks talk to each other. They talk to the IMF. And I'm pretty sure that, Malaysia isn't going to, Malaysia Malaysia usually watches and see how it plays out, and then they'll make a decision on it. It would be nice to be one of the earlier ones to adopt, but let's see what happens, right? Okay. Leong Kin Sing says, they'll definitely need the central bank to Bank Negara to agree first, and obviously, they like I said, all the central banks talk to each other. So, let's see. There's another question, Caden. When Bitcoin used to pay hackers, okay, this one is a good one, and it's quite topical. A lot of these so-called hackers and ransom, they ask for ransom, and they ask for it in Bitcoin. I would say this, right? I do not condone breaking the law. In fact, I think traditional law enforcement methodology and methods are well established, and I have full trust that law enforcement will be able to continue using their forensic expertise, digital forensic expertise, to find and catch these criminals. So I have full trust in their abilities. I don't think this will derail it. If anything, it's the same, right? I mean, look, even central banks have been hacked. You probably just don't read that much about it, right? But yeah, even that's possible. So I have full trust in the capabilities and the abilities of law enforcement and their well-established digital forensic expertise to track down these criminals. So I don't think it's gonna derail it. Okay, so with greater adoption of crypto, what would that mean? Well, Bitcoin's market cap is at 700 billion. This was on one of ARK Invest's decks, and the potential market cap is this, right? Now, if Bitcoin were to capture just 5% of the global monetary base outside of the 4 largest fiat currencies, we're talking US dollar, the Japanese yen, Chinese yuan, and the euro, right? If we take those 4 biggest ones out, and 5% of every other fiat currency came into Bitcoin, that's another $2 trillion, right? So the potential would go up to $2 trillion. So that's what greater crypto adoption could mean, right? So so in US, hundreds of banks to offer crypto this year. NYDIG, as I mentioned, is the New York Digital Investment Group, a subsidiary of a $10 billion New York-based asset manager called Stone Ridge. Right? They've partnered with fintech giant Fidelity National Information Services to enable US banks to offer Bitcoin in coming months, according to the two firms. Hundreds of banks are already enrolled in the program, according to Patrick Sells, head of bank solutions at NYDIG. So while the firm is in discussions with some of the biggest US banks, many of the lenders that have agreed to participate are smaller institutions like Suncrest, a California-based community bank with 7 branches. So get ready for this, guys, right? Hundreds of banks in the US are likely to offer crypto this year, 2021. We're in June, so we're in the first half. There's a second half to go, right? 6 more months, so this will be interesting. Now, here's the other trend that banks are seeing, right? They're seeing that fiat deposits are flowing to exchanges. Right? Banks are now asking for Bitcoin because they can see their customers sending dollars to Coinbase, Kraken, and other crypto exchanges, according to Yan Zhao, president of NYDIG. This is not just the banks thinking that their clients want Bitcoin. They're saying we need to do this because we see the data, Zhao says. They're seeing deposits going to Coinbase, Coinbases and Galaxies and Krakens of the world. So what he's saying is that, look, the banks see all the data, right? And all this money is just going into these crypto exchanges, which means they're not holding as much deposits, which means they cannot lend out as much as well. So they got to capture some of this so that they still have, so that they can still be in existence, right? Question, CBDCs, are they a threat to traditional banks? Okay, so this is interesting. Now, for those of you who haven't heard, CBDC stand for Central Bank Digital Currencies, which means each country's central bank, so like the Bank Negara, instead of issuing paper currency, like Chinese New Year and Ang Pao time will be quite interesting, but they issue them digitally. So you just download an app. So if all Euro area citizens above the age of 15 transferred 3,000 euros of 12% of their average deposits into what would effectively be an ECB-controlled digital wallet, this could theoretically reduce Euro area total deposits, defined as households and non-financial corporations deposits, by 873 billion euros, or by 8%. So what this means that if the central banks start issuing CBDCs, they are now deposited with the central bank and not with your commercial banks that, like the Maybanks and the Morgan Stanleys of the world, right? It will suck out 8% of those deposits. Okay, so I think I'm on my last two slides. Okay, this was a recent, cover from The Economist, right? That the title was "Gulf Coins: The Digital Currencies That Will Transform Finance." I'll just read it out to you, right? It says, "Unconstrained, Gulf coins could fast become a dominant force in finance, particularly if network effects made it hard for people to opt out. They could destabilize banks because if most people and firms stash their cash at the central banks, lenders would have to find other sources of funding with which to back their loans. So as I said, we live in a fractional reserve banking system, which means if I deposit $1 in a bank, they pay me some interest and they will lend out $11, right? At a higher interest rate, right? That's how banks make money. So if you take that deposit away from the bank and you move it to the central bank, of course that then they have less dollars deposited with them. Then they can lend out less, which means they can earn less in interest. So which means they will have to downsize, right, or shrink. Now, what's interesting is what you give up for convenience. It also introduces privacy matters, right? Privacy issues where now you're, you can say things like, oh, look, I've got nothing to hide, I pay my taxes and blah, blah, blah. But it just means that whoever has access to those banking systems will have a full picture of exactly how you spend your money, where you spend your money, where your money goes, and is fully transparent in that for those who have access to the banking system, right? So I think we're okay. So this is the last slide, right? Are the tides finally turning? Okay, so look, I think we covered a lot tonight. I'll quickly address some of the comments that are coming in right now. But yeah, so hey, look, banks, Bitcoin, crypto, right? You guys see the trends. You guys see what's happening. They each have their views. And so we got front row seats, right? Bring out the popcorn and enjoy the show. Okay, so Alex says, "Hey, crime will always happen with crypto or not." That is true, right? Crime always, even before crypto was invented, we always had crime. So that's right. So Leon Kinsing says, offering crypto, does that mean these banks also buy and allow transaction using cryptos, or just a chargeable service for their clients to trade crypto? Kinseng, I think it's both, I believe, because so that means banks, like, have you heard of having a multi-currency banking account? So so you can actually custody your crypto with your bank, for example. So you're still you're still depositing instead of ringgit or dollars. I mean, like right now you can deposit. You want to have a multi-currency account. You want to have some pound. You want to have some euro, some US dollars, and then ringgit. And next, you can have an extra option of maybe Bitcoin and other crypto, right? So you're still depositing with these banks. They are holding it in custody for you, and that gives them the ability to then lend out and charge interest for lending out, right? But then they also, because if everyone is also then depositing their crypto with the banks, they know everybody's balance. And some people might want to change. You might want to log in one day into your Maybank to you, and you're like, hey, the rate for Bitcoin to ringgit is good. I'm going to convert my Bitcoin into ringgit. And when you do that, the backend systems will probably link with someone else who wants to, buy Bitcoin from ringgit to Bitcoin, and so they will do the order matching, and then So I believe that's both. Caden says, CBDCs a threat to crypto rather than traditional bank. I think that's a good one. I think, look, CBDCs, I think their focus is probably to have perhaps more control, right, or absolute control over money. They can have monetary policies that are customized to different segments of the economy and different people. So maybe if they're giving out stimulus money, they may dictate, right? They will send you the stimulus money. You got yay, you got free money in your phone, but they may dictate this money comes with conditions, and it has an expiry date. You can only spend it at these stores, and you have to spend it before the end of the month, and you can only spend it in approved stores, and you cannot use it to buy crypto, for example. So I see that as so that the central banks will have full control and very sophisticated type of monetary policies that they can roll out. So like, whereas in America right now in the existing system, central banks are mailing out checks. People are cashing in their checks and they can buy whatever they want. They might even save the money. Some will use it to buy food and pay for rent. And some of them will probably use the money to buy Bitcoin. So they can't control that. But when they have CBDCs, they will have absolute control of these monetary policies, of how you spend that money, where that money goes. So that is what, if I were a central bank, that's what I would do, right? To sort of have full control, absolute control of that. So will it threaten traditional banks, and will it threaten crypto? I see. I guess my view is more plural. Like, it's a world of plurality, right? It's. I think each will have its own space. It will live in harmony with the other two. That's kind of how I see it, right? Because I think some people, because central banks may not offer you the ability to custody your crypto. So you still have to go to a traditional bank to custody your crypto, just like a multi-currency account. You might not want to self-custody your own crypto, but some people might want to self-custody their own crypto and hold it themselves, right? So I think, just like when the internet arrived, you would think that, hey, newspapers are dead because now we have the internet. Look, newspapers and magazines are still selling, right? They're not dead. But they live in harmony. So I think there's a space for all three. So I see a world of plurality, because each group will be trying to solve different problems, right? So that's kind of my view. One last comment from Alex, and then we'll go. CBDCs are more response to crypto rather than threaten crypto per se. Central banks are being on the defensive here. Okay. Thank you, Alex. All right, guys. Thank you for sticking around so long. We've been about an hour and 22 minutes. I hope you have benefited from tonight's episode, and I hope it gives you something to think about the future, right? And look, there's so many things happening in this space, and so many things going in different directions. But it is, exciting times. So tread carefully. Like I said, none of this is financial advice. And think of I think of it as a very exciting time right now to be alive. In all honesty, I mean, besides the whole pandemic thing, but as we see this play out, I mean, this is a change it's an inflection point, isn't it? And it'll be a point in history, right? History books will write about this transition, the great transition, right? Some will call it the separation of money and state, right? Of course, a lot of states will want to keep control of their money creation, money supply. But then, like countries, like very poor countries like El Salvador, which have already used the U.S. dollar as their legal tender, they've already lost control of that, right? They've already had separation of money and state, and for them, it makes perfect sense to pick, to still use the U.S. dollar because that's the reserve currency of the world, but to also add Bitcoin because Bitcoin is leaderless. and is not controlled by anyone, and the supply amount is fixed, and so it seems like a very fair system to someone like El Salvador, right, who don't have their own currency anymore. So, and if you look at the world map, there are a lot more poor countries than there are rich countries. So, I'm just enjoying the show. This is I'm just happy to be alive to watch this happen. Look, thank you guys. I thank you for staying till so late. But I get very passionate talking about this because it's just it involves all of us, and it doesn't just involve us in Malaysia. It involves everyone around the globe. Everyone's participating. Everyone's going to be affected. We've got a few more. Okay, look, hey, so thank you, Alex. Thank you, Chia Siu Hun. Thank you, Leong Sun To. Yin Xiaoming, thank you. Thanks, Nicholas. Thank you, Alex. Okay, one last question, right? Should LTC be valued closer to a quarter of Bitcoin's price? Bitcoin's price. Hey, look, I don't know. I guess. In my books, I think it should. But again, this is not financial advice, and I think it should. But who knows? Market forces, right? So the market will determine, right? Mr. Market will tell you what it is. All right. Have a good night. Have a nice evening, and stay safe, everyone. I'll see you next week. Take care. Bye-bye.